Good morning, everyone. Kia ora koutou. Welcome to our webinar this morning. I'm Greg Harford from Retail NZ. For those of you who don't know me, I'm here with Nigel Pounds, our partners manager. And with us from other parts of the country, we've got Jay Hong and Rachel Nottingham from Occupize here to talk to us today a little bit about leases. Leases are obviously really critical for retail businesses and managing those, finding the right lease, potentially working through some of the issues around leases that have arisen as a result of COVID-19 are all really important. So we're really grateful, Jay and Rachel, to have you here with us. And at this point, I'll hand over to you. We do have the opportunity to have questions. If you have questions through the webinar, please just use the question functionality. You should have a little button in front of you there and fire them through. And I should also just mention that we are recording this session and it will be available if you need to come back and look at it again. So with that, I'll hand over to you, Jay, and look forward to hearing from you.
Cool, excellent. I'm just gonna show my screen. Excellent. Hopefully you can.
Yeah, it's looking good, Jay.
Cool. Yeah, hi everyone. Yeah, so as Nigel and Greg has introduced, Jay, Director of Occupize, we do a whole lot of work around leases, helping tenants get the right, I guess, negotiation tactic, but also helping around, making a whole lot of informed commercial decisions around your leases. So I guess the key outcomes for what we wanted to talk to you today about was, we want to make sure that we get a better deal in negotiations with your landlord. How do you measure your property costs and find out if you're paying too much as well? You also want to obviously align your business goals with your lease. So as Greg has said, if you have any specific questions, feel free to ask them at the Q&A, or reach out to myself or Rachel at the end. So, so I guess the first point that I wanted to talk about is how retail leases fare and compare. So though landlords see childcares, hairdressers, fashion retailers, or public-facing offices, all in what they consider retail spaces, each industry and tenant has a different benchmark to what they can afford and rent. So even though childcare might be in a retail space, they might have a benchmark of say 15 to 20% of their revenue that they should be allocating to their property occupancy costs, which includes rent and other expenses like rates and insurance. Whereas for fashion retail, it might be close to 10% of your revenue that you want to associate to your property costs. Even a backroom office space with a front-facing retail portion might be charged the same retail rent as well. The exact same dollar per square meter, the exact same space. So the landlords, unfortunately, don't care what industry is in or what business there is in their retail space. So it's really important to make sure that you're paying a benchmark percentage close to what your other peers in the industry are paying. Property costs as well have and always will rise higher than inflation. As you know, inflation usually reflects your expected revenue growth, which is currently obviously sitting below 2%. So you'd expect the same slow growth to remain for your expenses as well, such as property costs. However, as most of us know, CPI or fixed rent reviews, or a mixture of both, such as CPI plus 2% rent increases a year, as well as the way that market rent reviews are calculated, means rent more often than not rises above the rate of inflation. Usually that obviously means that your margins are expected to be squeezed. So it's important to know what you're paying for. What are you, the tenant, and the landlord versus the landlord accountable for, as well as looking at a longer term picture as well. So I'll have more details around what you versus the landlord might be responsible for in a little bit down the line. So what have we seen as a result of COVID in the retail property leasing landscape? Well, we've seen a lot of lease terms now being more flexible with shorter initial terms and more frequent lease renewals. Also seeing rent incentives for new lease terms. And when I mean by new lease terms, not just talking about brand new leases, but also renewal of lease terms. The rent incentives have increased. Many tenants now are demanding 6 months of the rent holiday incentive as compared to say 3 months, which is pre-COVID. And rent holidays are typically awarded by the landlord to allow a tenant to get a runway to setting up the business as well as building revenue without sacrificing rent. So, I mean, many of you may have also heard of what we call the pandemic clause, clause 27.5 in the latest form of the ADLS, and it's the benefit of a newer form of lease which allows you, the tenant, to take advantage of being able to negotiate rent relief during times of COVID, times like COVID. Not just for rent, but operating expenses as well. Unfortunately, older leases don't really benefit from such a clause. So, obviously a new lease is an opportunity to discuss whether such a clause can be incorporated out of fairness. If you were to, whether that be a brand new lease or whether it be a renewal. It's in the landlord's best interest, obviously, to have used the tenant achieve business continuity, as cash flow for them is via rent is their bread and butter. So we've seen landlords provide rent relief even for older leases without the clause as a goodwill gesture. There hasn't been, or there wasn't a standard approach on how the landlord should be approached around, what is fair proportion, but tenants have typically received between 20 and 50% during the second round of COVID for some of us in Auckland. However, there's been less reluctance for that fair proportion of rent relief. So it's important to note that what proportion of rent relief is considered fair is not really defined. So you're better to have a conversation around where your business is heading, kind of what your current performance is with your landlord, rather than around what percentage is fair, rather than say what a lot of corporate tenants have done, which is go to landlords and say, you must give us 50%. There's no real definition of what that percentage should be at the moment. So it's important to have that discussion. Just some key clauses to consider in your lease to allow for flexibility. Flexibility is an area where the landlords and the tenants are most at odds. Tenants often want more flexibility. Landlords obviously want to give much less. Areas where you'd want to seek flexibility, whether that be that might be length of term, so having a shorter term, more frequent renewals. Maybe you want to transfer your business or your space by selling the lease or subletting, and obviously the conditions that go along with that. I'll talk a bit about that later on. Maybe you want to have a change of layout, alterations to your premises without having landlord consent. Obviously, you don't want that cap every time you want to paint your premises or do something to the flooring. Or flexibility of products of what you're selling, as well as what you could do in your space as well. Flexibility also includes rent to reflect market conditions. I mean, if your rent increase is a CPI plus 2% per annum. So with market rent reviews every few years being on a hard ratchet meaning your new rent not being able to fall below the previous year rent. It's not reflective of the speed of inflation, which ultimately means you're hamstringing margins as well. Not very helpful if you're more starting to vacate and your landlord's offering rent at a much lower rate than what you're currently on, in order to, say, attract tenants to the exact same space that you're in. I mean, if that's the case, you want your rent on market rent reviews to be able to fall to a level that's reflective of your current or your surrounding environment as well. So another thing to consider is flexibility generally costs. So what flexibility are you looking for? What are you willing to pay the landlord? It depends on your strategy, and I'll talk a bit more about that in the next section. A few more key considerations around lease security. I mean, you need to have a balance between flexibility and security. Lease terms usually give you a security of tenure, which obviously means the right to stay in your premises. The security of rent as well. For tenants, it usually means the certainty of rent, the sustainability of rent as well across the whole term of the lease. What's the landlord asking for in terms of security of rent payments? What is reasonable depends on your business maturity, your business reputation, as well as negotiation position as well. Usually that's personal guarantees, which is standard for companies, but also bank deposits as well. And finally, security for landlord's interest. What's the landlord's commitment to keeping you there? Do you have a demolition clause in your lease that allows the landlord to terminate the lease based on their intention to develop your shop? What's the landlord's intention for the centre as well? I guess the final point I want to raise, something that we've seen quite often is if you get in trouble, negotiate, don't not pay. If you don't pay rent because you're holding out for an answer from your landlord around whether they might accept a new term or offer you rent relief during the second round of COVID, withholding that rent technically means you're in breach of your lease. Breaching any terms of the lease may mean not being guaranteed a renewed term or an extra extension by your landlord. So it's better not to be obviously in breach of any terms. It shows confidence to the landlord that you're a blue chip tenant when it comes to negotiations, with a low likelihood of defaulting as well. And finally, understanding hidden costs. What are you as the landlord responsible for? One of the things that we've come across, one of the hidden costs that a lot of tenants oversee are final make good costs, or alterations when they leave a premises. If a business is considering shifting a premises or closing shop, there's some hidden costs to consider. Usually under most make good obligations in a lease, the tenant at the end of the lease you have to return the premises back to the original condition. Obviously at the moment, at the start of your lease, if you don't have a premises condition report, there's no evidence of what that original condition is interpreted as, meaning the cost to reinstate a property might vary depending on the landlord. So should the business decide to remain in the current site, deferring those make good obligations to the expiry of the new lease or the expiry of a renewal term should be a discussion point with your landlord. So I guess in creating a strategy, how can you reduce costs and some of the other capital costs around fit outs? Well, I guess when creating a strategy, do you plan to sell the business within the next, say, 2 years, or maybe you want to plan to hold on to the business, but you want to streamline costs? Or if you want to sell the business, need to ensure that you create enough security for the purchaser, obviously, to make a return on the business. Remember, unless you can transfer the goodwill of a business to a different location, the business is only as good as the term of the lease. At the same time, though, if you can't sell the business within the next 2 years and you want an option to exit, well, creating multiple but short renewal terms will be critical. So remember, there's a lot of this comes at a cost. So understand what the landlord wants, and be prepared to give away things that might not be important compared to flexible terms such as rent. Maybe a longer initial term, possibly a no rent incentive. So an example term that encapsulates both security, or if you want to sell your business, the security along with flexibility might be, well, instead of having three 5-year terms, having 5 3-year terms, so you're having shorter terms but more of them. So assuming you don't breach, the right of renewal is at your discretion, which gives yourself obviously more bargaining power at every renewal. Whether it's a market rent review that coincides with a renewal where the market rent review has been indicated by the landlord as being too high for yourself to afford, or maybe you're wanting a stepped rent increase. The more renewal opportunities there are, the more opportunities for your landlord to listen to you, but obviously give you more outs if you wanted to exit the lease as well. In terms of streamlining costs, a few ways that you can reduce costs is, check your outgoings, such as what are you paying for insurance? I mean, we've seen tenants pay thousands on landlord's insurance every year that they might not be liable for. So when they send through an invoice, check that they're, it's in line with what your outgoings of your lease are. Are you being charged for 24 months worth of cover, or are you being charged for 12-month term? Are you paying for the landlord's statutory liability insurance, which we've seen a lot of tenants pay for, but they shouldn't be paying for every year? Are you paying for replacement servicing costs as well? To replace air conditioning units. It's not your cost to have to replace those services, but we've seen a lot of tenants having to fork out thousands per air conditioning unit to having to pay for those. Even having to address indirect costs as a result to weather tightness, such as having to rejig ceilings. I mean, you shouldn't be having to pay for those. Something important you should probably do with your accountant, if you're not doing so already, is to ensure that you're accruing for payments the landlord should have charged you. So there's nothing stopping the landlord from coming to you saying, "Hey, I forgot to charge you 3 years worth of rates, insurance, etc. So I want a lump sum now of those 3 years worth of rates." The same goes for fixed increases. Just because the landlord doesn't give you an invoice for that extra 3% of rent increase doesn't mean that you might be able to get away with it without not having to pay for it down the line. Obviously, don't poke the bear and ask for an invoice for those 3 years worth of rates, or that 3% rent increase that was meant to happen over the last 2 years. But just make sure you're accruing it with your accountant so that it's not a surprise cost if it does come through. It happens more regularly than you think, where some landlords have in the past at renewals have hamstrung tenants saying, I'll clear this $20,000 payment on the basis that you renew further term. You don't want to be pushed into that corner. So one way to promoting a fairer way for rents to be calculated, especially for retail tenants, is as a performance type rent, where you pay a rent based on your revenue with a cap for the landlord. So as an example, this might mean you're paying rent 7% of revenue, with the rent not falling below 80% of what's considered a market rent per square meter. obviously the benefit of that is, you're guaranteeing a minimum return for the landlord, but it incentivizes both you and the landlord to achieve the higher levels of performance, the higher levels of revenue as well. It also means that if you're not reaching a revenue that you want to get to, then you're not having to pay 100% of what a market rent is, but you're getting a 20% discount as well. I guess the second round of COVID has made us aware that COVID's not suddenly going to go away, and there's a fair allocation of risk between both the tenant and the landlord as well. If COVID is to affect us every 3 to 6 months, it's important to streamline costs. What the landlords give are all on a goodwill basis. So prioritize what's most important to you, as you want. It's really hard to get everything that you want. If contributions to a fit out is important to you, prioritize that, say, over an extension term, which might not be as important. So when you're making alterations as well, depends on the lease. But it's important to ask for the landlord's permission. We've seen so many leases where tenants have painted the interior or installed a reception area, which might require a building consent, by the way, only for the landlord to find out post all these works and get the tenant to take it out. So make sure you keep the landlords informed about your plan. I guess one of the strategies that you can employ if you don't have the capital to be able to re-spruce your area, say you wanted 80k to be able to go from a wooden floor to a river marble flooring, to have river marble flooring, or you wanted to have bench tops. The strategy is to ask for a contribution from your landlord, especially if it's adding value one way or another to the landlord's premises. Maybe the landlords are willing to contribute, say, 50%. For your portion of the contribution, for fit out contributions, ask the landlord if you could pay a lease improvement or fit out rent if you don't have 80k in your back pocket. I mean, it means instead of paying a lump sum for your fit outs, you're paying the landlord over a number of years for additional rent. And obviously the landlord will be funding for your fit outs and your upgrades. The obvious benefits are, well, if the improvement rent, if say the improvement rent was agreed to be paid over 8 to 10 years, depending on what the upgrades are, and say you leave before that date, it means you would have only paid a fraction of that initial lump sum back to the landlord, or that lump sum that you would have paid over time. And it really depends on the lease, but the landlord would have also benefited off the fit out as well, as it would have allowed them to get more rent from the next tenant. It's easier for them to market as you've maybe got rid of some soundproofing or put some inbuilt cabinets as well. I think that was. Don't know what's going on, but I think that was, I guess, a quick overview of some of the strategies that we have. Some ways to reduce costs, along with some of the key lease terms as well. Greg and Nigel, I mean, we're happy to take any questions that people might have, but hopefully that helps clarify some of the unknowns that are around leases.
Excellent. Thank you very much, Jay. There's a couple of questions that have come through, and if anyone does have any more questions, please just drop them in through the question facility there. I guess just to start off, you talk about landlords making contributions to fit out. What's your experience of the likelihood of that happening? Are landlords reasonably keen to come to the party, particularly in the current market?
Yeah, absolutely. I think, I mean, again, it really it comes down to whether they'd be willing to operate or contribute 50%, or so whether you want them to contribute a lump sum or you want them to contribute the whole amount on the basis that you pay them back on a higher rent. We have seen landlords are quite receptive to that. It's at the end, it is an increase to their capital costs as well. So, a lot of landlords prefer to have an extra, to get extra rent on the basis that, obviously they fund for this. But we have seen a lot of landlords contribute, say, 25%, 50%, depending on what you're putting in. Yeah.
Okay. There's another question here. I think around what you should be doing now to prepare yourself for when your lease expires. If your renewal of a lease is still a year or two away, is there anything you can and should be doing now to prepare yourselves for that?
Yeah. So even though some renewals might be 1 to 2 years out, it's important to start discussions early with your landlords. I mean, too often we've seen tenants leave discussions too late, 3 months, 6 months out to a renewal date, where a lot of tenants have been hamstrung into last-minute leases that are onerous. As long as there's something in it for the landlord, there's always a discussion you can have, but it's really important to have that discussion early, because obviously some landlords will know as you get closer to a renewal date, you're kind of hamstrung into that time frame as well. So see what the current, see what the landlord's pain points are. Most tenants think that they're in a deadlock with the landlord, at their mercy of the landlord as well. But it's important to remember that the landlords have an invested interest in your success. I mean, no tenant means no cash flow, which is obviously detrimental for them in times like this. So it's providing security for the landlord, whether it be, whether you have a brand new lease as well. Ask them if you're a year or 2 years out, see if they'd bite for a new lease, but have favourable terms for you as well. Provides them security, so it's a win-win for both parties.
Finally, there's a question here about calculating benchmark costs. How do I calculate my gross occupancy cost?
Yeah, so gross occupancy costs usually means all your property costs that you're accountable to. So it includes rent, rates, insurance. So you add all those up. And malls, that might also mean that also includes marketing costs, along with any retail operators costs as part of that, a separate agreement that you might have. So when you add all those costs up and you divide it by your revenue, it shows how much of your revenue you're spending on property. So a lot of tenants, or a lot of businesses over time lose sight of what percentage of your revenue are you paying on property costs, not just on rent, but again all the other expenses. But it's important to benchmark against some of the other tenants in your industry. I mean, some of the other peers in your industry. Say if men's fashion is everyone around you is paying 7% of your revenue on property costs, women's fashion might be closer to 9%. There's a different benchmark for different industries, so it's just important to make sure that you're not overpaying compared to the rest of your industry.
There's two questions about malls really that have come in. First, what should we be paying in marketing costs for New Zealand shopping malls?
Rachel, should I? Oh. Okay, I'll answer that one. Yeah, so it really comes down to I guess the mall by mall basis. I mean, from what I've heard, some of the larger malls might get you to pay for, all those banisters at the front. If the overall cost for all the tenants is say 200 grand for putting that up, a proportion of that may come to you. I mean, it really comes down to what the landlord does, and unfortunately, a lot of times you're at the mercy of the landlord for what those marketing costs are. But at the same time, you are paying, whatever those costs are, whether it's 5 or 6 grand a year. If they can't show you what you're getting out of that cost, I think it's a discussion you can have about maybe should you even contribute for that to the overall centre's marketing costs. They should be able to tell you what those costs are going into, or giving you at least an evidence of it, showing you the proportion of it in your invoices as well.
Sorry, we're muted here. And just finally, unless there's any further questions from anyone, I'm just keen to understand, one of the bugbears of many retailers is the requirements of shopping malls to be open at particular hours and particular times of the days. Do you see any greater willingness of landlords to engage more consultatively on those matters, and potentially offer greater flexibility to retailers?
Yeah, I think it's a lot of that usually comes through in the retail trading agreement, which sits behind the lease. I think if those discussions definitely is something you should have as part of your lease renewal negotiations, but I think a lot of those times that are set, might be unconditional to I guess to the landlord. I mean, it really comes down to, on a case by case basis, what are you doing in your premises as well? Are you expected to open late for something where you're not going to see any revenue off after a certain time? It might not be reasonable, but if it's in the retail trading agreement, it's definitely something which you have to, I guess, discuss with you. I think that it's a little bit tricky, because it'll be on a case by case basis, and what business are you running in that shop? What are you allowed to run there? I think that really drives that. Will drive that discussion.
All right, thank you. And there's one final question that's just come in. Is there a standardised cost for a new rent agreement, and does the tenant still pay?
Standardised costs, I'm guessing, for when drafting an agreement. Standardised costs. I'm not sure if that means. I guess if that means on a rent basis, if the landlord's saying, it's the set charge is $270 a square metre. The set cost is $270 a square metre, so this is what you're going to pay. The landlord's quite set on having to charge that amount. There's ways around it. Whether that be a stepped increase. Instead of paying $100,000 a year from the get-go, asking for, say, $60,000 a year for the first year, $80,000 a year for the second year, and $100,000 for the third year, which allows for you to get up to speed, get your foot in, put your stake in the ground, and really get your business going. If the question means lease costs around what the landlord should pay versus what you should pay around legal costs, I guess usually, historically, for during leases, whether you're drafting up new renewal terms or new rent review documents, the tenant had to pay for a lot of that, even the landlord's cost as well. But I guess you're now expected to pay for your own costs. If you're engaging your own solicitor to draft up some terms for a deed of lease, and you're expected to obviously pay for your own costs for that. And if the landlord's paying for their own legal costs. They've got their own solicitor on there, and they're expected to pay for that as well. So it's really hard to obviously put a number to that, and how much solicitors are going to cost you. But I think as long as you can have a lot of the first schedule of the lease, rent term, renewal term, as well as the rent amount, along with some of those specialized clauses you might want in there, whether that be that pandemic clause. If you can, I guess, have those discussions with your landlords as much as you can, then it'll probably save you on some of the solicitors' costs that you might be expected to pay for negotiating on your behalf, I guess.
Yeah, so always better to try and have those conversations directly rather than through the lawyers. I suspect will help as well.
That's right.
All right. Well, look, thank you very much, Jay and Rachel. I think we've come to the end of our questions. That's been really informative, really useful. Certainly, I think very encouraging that we're seeing a bit more flexibility from landlords coming through at the present time, and some of those rent incentives are getting better as well. So some really useful advice from you there, and I'd like to thank you very much for taking part in our webinar this morning. And if anyone needs to contact Jay, we can provide contact details, and if you've got any more questions, please do feel free to reach out to us here at advice@retail.kiwi. We'll draw the webinar to a close now, and thank you very much.